our session has started. So basically, when we talk about liquidity, we mean money, right? Liquidity is money, right? Don't be vexed with a lot of jargon that people use and everything. So why do we have liquidity in the market? Why do we have money in the market? We have money in the market because the market is moved by money. Okay. The person who's writing on my whiteboard, please can you stop? It's for the say only. Thank you. So for us to be going in an uptrend and for us to be going in a downtrend, we need what we call money, right? Or we need what we call liquidity, right? So as the market moves, it means that our liquidity is more in the bullish direction. And as our market moves down, it means that our liquidity is more in the bearish direction. So that means when we go up, we've injected more money to move the market up. And when we go down, we've injected more money to make the market go down. Okay, right. Now, we don't really talk about liquidity for nothing. We talk about liquidity because we have specific areas and zones where there is more liquidity in the market than other areas, right? There's someone who's writing on the whiteboard. Please, can you note? I can spot your name. Let me not say your name. Fun enough, is my student. Gwen, please stop doing that. Okay, so as we talk about liquidity, we have more areas. We have areas that have more liquidity than other areas, right? So it's just a simple practice that we need to do. Okay. So areas which mainly consists of what we call equal highs are areas that we should be careful of, right? And the whole concept in this is whenever we spot equal highs, we tend to sell the market. And why do we sell the market? Because we are assuming that we've come across a certain resistance area, right? Please note this down. Even a normal trader, a normal price action trader, a normal whatever kind of strategy trader, when you see an equal high, equal tops, equal bottoms, we tend to, if it's an equal high, we tend to sell the market. And if it's an equal low, we tend to buy the market, right? But we should be careful of these. Everyone is talking about smart money these days. Smart money, smart money, smart money, right? This is another concept of smart money. So imagine you are a normal okay, we are all normal traders in here. So imagine you have spotted your equal high. The first thing that comes in your mind is to sell. And when you sell the market, where do you put your stop loss? We have always learned that we put our stop losses right above our entry or a certain distance above our entry, right? So let's say this is John. John sees that he has an equal high and he sells the market. John now puts his stop loss here and says, you know what, I'm going to make money and I'm going to be moving a wide range of pips. But now what John doesn't know is it's not only John who's trading the market. Also, a whole lot of traders are also trading the market. Why? Because they've seen this equal high. So we begin to accumulate a lot of stop losses here. A lot of stop losses are put here. A lot of stop losses are put here. A lot of stop losses are put here, right? And what do these stop losses mean? These stop losses mean money, or they mean liquidity. Now we have very high liquidity at this area. Remember, when we are trading Forex, we are not just taking, right? In order for someone to win, someone also has to lose, right? And at the end of the day, we are fighting against the financial market. And the financial market is what? Is its own market makers, right? So, as the traders who are trading from home, we see this, and our stop losses are accumulating here. And our stop losses are accumulating here. There is a lot of money here, right? Meaning that if by any chance institutions or market makers manage to move the market a bit above this area, they hit our stop losses. And as they hit our stop losses, what do? They take our money and then they move us away from the market, meaning that we have lost. Now, this is a simple trick that the market makers or that the institutions use to trick us into trade. Right. I want you to note this down. If you have a pen, if you have a paper, note this down, write this down in your notebook. Small traders do not move the market, but big institutions as banks, they move the market. And how do they do this? Right. Let me do this in a clear way. I'm going to redraw my diagram, but I'm going to do it in a more clearer way. And I want space here. So we've spotted our equal high. We have placed our sell and we've put our stop loss here, right? And there is money here. Remember, institutions, they do not trade in line with retail traders, small retail traders. But some of the small retail traders who are smart enough, they trade in line with big institutions. So what do they do now? This is why I always tell people there is no such thing as stop hands. Or I don't believe in stop hands. All these moves are calculated moves. And it only takes a very wise eye and a very learned eye to spot these moves. Once I spot an equal high, for me, I don't sell, I wait. So what institutions usually do now is they inject money in the market and then they buy. They come, they hit your stop losses, you are taken out of the market, right? And the way that they buy is they release a very big candle which moves so fast that when it even hits your stop losses, you start thinking that the market is now buying. And then what do? You start buying, right? I have once taught this concept, but I'm going to teach it again. So say these institutions now, they inject 10 million to form this candle, and it starts moving the market and it buys, right? If they inject the 10 million, it means that now the 10 million is in profit, right? It's good enough to what? To move the market. And the same time that they inject the 10 million to buy, they can as well inject 100 million to sell. I want you to get this concept. Why do they do this? They do this so that they find a perfect entry point that leaves them alone in the market. It's now the big fish that's in the market, and the big fish has taken small money. Right. Remember, they've injected 10 million in the market, and as they inject the other 100 million in the market, it means now as we go down, that 10 million is getting into loss and that 100 million is getting into profit. Why do they do this? Remember, banks also want to make profit. Large institutions also want to make profit, and this is the only way that they make profit. Right. And as they exhaust the market, let's say they exit their 100 million a year. When they injected the 100 million, maybe now it's 350 million, somewhere there. And our $10 million loss that they first injected to push the market up so that they could vex us, now let's say it's in $50 million loss. And what do they do? They start going up, 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 until they reach their break even or the entry point where they injected the 10 million, and then they exit their 10 million in profit or in small profits or at break even. And then now what does the market do? It starts going in the right direction. Right. I'm taking stages in explaining these things so that we all understand. Right. So basically now, just because you saw a equal high and you sold, and then they vexed you, they bought, and you exited the sell, you entered the buy, and just when you entered the buy, they sold, meaning that your sell was hit stop loss, and then your buy was hit stop loss, and then you are left with little money or no money to trade at all. So this candle now that they first inject to go up is called a funded candle or an institutionally funded candle. And this is how they grab money and hit your stop losses. And then you start saying there was manipulation in the market, whereas you traded an equal high. Or the same scenario can happen for an equal low, where they can come like this, right? Let me just do this one first because we now know the hang of it. You get an equal low, right? And then you enter in a buy. And when you enter in a buy, they inject money to force a sell so that they come and hit your stop loss. And when soon after hitting your stop loss, they force another buy so that they also make money from the buy. And then they exit their buy, they come back to exit the entry that they took first to sell, and then they start continuing in the intended direction. Right. And then you start crying foul play, whereas you had entered an equal low or a double bottom. Right. Now, I've finished, I'm not leaving this. I will get further in detail with this in our mentorship classes, but I'm just saying so that we can all see what happens or things that we are not seeing in the market. Now we have what we call fair value gaps or a market imbalance. Right. Now, a fair value gap or a market imbalance, where do we find this? We find this both in a downtrending market and in an uptrending market. Guys, if you have a pen or a paper, if you have a pen, a book, a paper, or anything that you can write this, I want you to write this. And if you can draw it the same way that I'm drawing it, please draw it, because this is also as equally important, and you can trade using this concept and make money, right? We have what we call healthy price action. What is price action? Price action is basically candlestick formation. That's how we define price action. So as we go up, we expect our candles to behave in a manner. And as we go down, we also expect our candles to behave in a certain manner. These are the things that people don't really know. When we make a candle, right? When we make a candle, it usually has a tail, right? This is candle number 1. And we have candle number 2. Candle number 2 also has a tail, right? Candle number 2, we don't really have much concern with candle number 2, but we have concern with candle number 1 and candle number 3 that I'm going to be drawing here. For us to be saying that we have a market balance, candle number 3 must look something like this. The tail of candle number 1 and the tail of candle number 2 must connect at the same level, or they can even pass each other. This is what we call a balanced market. Be it a daily candlestick, be it a 4-hour candlestick, be it a 1-hour candlestick. As we move up or down, candlestick number 1 tail and candlestick number 3 tail must link like this, right? But the moment that this starts happening, the moment that we start seeing candle number 3 like this, right? We now have a market imbalance. Why are we saying that we have a market imbalance? Because we have a gap between these two tails, right? I want you to get this concept very clear, guys. And please, if you just have any way where you can write this down, or you can note this down, note it. Right. So as we get what we call a market imbalance, at some later stage, price must come and fill this gap and then fall down. And the best way we can trade this with this kind of setup is we measure 50% of the gap, right? Let's say our 50% is this one. Okay. Let's say that is our 50%. We measure 50% of that gap and we wait for price to come back and hit that 50%. And that 50% is our entry point, meaning that price can go down, do what it likes, and as it comes and taps on our 50%, this is where we start taking our entries and we hope for the market to fall down. Why? Because we have filled the market imbalance, right? But it doesn't necessarily mean price cannot go above the 50. It can go above the 50, come to the 100%, and then fill that imbalance and then go down. I bet if you look at your chart right now, you'll be like, oh, I wish I saw this all along. Right. So basically this, with just knowing this, you can be able to know that my price is going to come back, fill my gap. I start taking my entries at the 50%, and then my price can fall down in the future. Okay, let me show you on a real chart what I mean when I'm talking about this. Let me show you on a real chart, because all these concepts, we don't just talk them, we also look for them and we trade them. Okay, so let me share my screen now. Okay, okay. Now let's look for an imbalance and let's see where it was filled, and let's see how they filled it. Okay, first of all, I see imbalance here and imbalance there. There's an imbalance that I see. I see an imbalance here with this candle, with this candle, right here, meaning that when we left this imbalance, let me do this. When we left this imbalance here, price it to come, fill the 50% and then fall. And what happened? Price came, went above the 50%. It's just tapped on it like this, and then it started falling. Let's look for another imbalance and where it was filled. We have an imbalance, we have a tail here, we have a tail here. So we can come grab here, we can come put there on that tail like this. And what do we see? If we measure 50% of that imbalance, let me do this. We can see that price came down. We left an imbalance here before this candlestick started showing. We had a rally down, come fill 50% of that level and then fall. Let's look for another imbalance. These imbalances can be found in any time frame. We have a tail here, we have a tail here. These are not interlinked. So we measure 50% of that. We first mark that imbalance like this. Okay. Let me put it there. And when we get the imbalance, what do? We measure 50% of that imbalance. So my first entry would have been either 50% here. It came, it tapped, it fell. It came again, it tapped on the 100, it fell. It came again, tapped on the 100, and then it continued rallying down for a very long time till now. We also have another imbalance here. No, this one is not an imbalance. But basically, I can safely say that these imbalances that I'm showing you, you can see them. We also have a market imbalance here and here. This one hasn't been filled yet, but it's still going to come and get filled in the future. So now I know that this is my other entry point for future reference. Okay. So basically, we don't have much time to continue talking about imbalances and everything. Our time will be running out. Now let me go back to sharing my whiteboard, and I'm now going to be answering your questions. If you have more questions, I'm going to also unmute the groups on our WhatsApp so that you also ask after this session. Okay. Now let me start with the first question that we have. How much is mentorship? Mentorship, I have mentorship for $200, $300, and $400. And the way that they differ is for $100, for $200 is price action, $300 is price action in BTMM, $400 is smart money price action in BTMM. Okay, how best can you raise any amount to big figures, trading crash and boom? Risk management, setting daily targets. Basically, that's it. Risk management, daily targets, discipline only. Can you help me through trading psychology? Yeah. This one now needs you to develop that lever. You know, it just doesn't come naturally, but it comes with time. Sometimes A lot of people, they get a steady mind in trading, depending on how many accounts they've blown. And then some, it's just over time. Maybe the wrong time, but I wanted to know if there's going to be anything for those who wanted a live trading session. Yeah, the live trading session, we're going to be having it tomorrow on Instagram. So I'll give you the Instagram handle. And definitely, definitely, we're going to be having a live trading session on Instagram tomorrow. Maybe the wrong, okay, okay. Let me answer your questions, guys. Let me scroll down. Say, how best can we know if it's time to place a buy or to sell? With different confirmations that we have, generally one has to know what suits him or her. Some people, they trade with EMA lines, EMA line crossing. Some people, they trade with rejections. Yes, for me personally, I trade with candlestick formation. I can easily tell if it's a morning star or an evening star that's going to be created, if it's going to be bearish or is engulfing. Now, this takes just knowledge and your exposure with the charts. So this one now is a broad topic that we can actually work on the day after tomorrow when we have another Zoom. We can have a Zoom on how to make entries. So, okay, definitely the day after tomorrow, we are going to be having a Zoom on how to make entries, because I know a lot of people, they get confused with that. Say, which time frame is best to use on market cap? Any time frame, but try as much not to use M5 and M1, but from M15, M13 and above. Okay. How do you set SL and TP when trading imbalances? Okay. The good thing about trading is imbalances is your stop loss is always tight and your TP is always tight. So you put your stop loss above the first candle, which is involved in the imbalance. What do I mean by this? I mean that, let me rub. This is actually a very good question and I'm happy to answer you. Okay. So this means that this is candle number 1, tail, candle number 2, tail, then we have our imbalance here, right? So our imbalance is somewhere here, right? So when you place your orders from the 50% to the 100% going down, you put your stop loss above this one, your candle number 1. Okay, I hope you get that. The imbalance, where are they best to see if the market is changing direction? Okay, just after the break of structure. If you don't know about break of structure, please can you kindly visit my YouTube channel? I talked about that. I don't understand how you see an imbalance. Can you please just recap quick? Okay. Okay, I think this will be one of the last questions that I'm going to be answering, specifically because we now have 4 minutes remaining and we haven't upgraded our Zoom yet. That's why I was even telling people to hurry up when they were joining our Zoom session. Okay, so you see this candle, it has a tail. You see this candle, it has a tail. But these tails, this tail and this tail, they've left a gap in between. So this means that there is an imbalance here. This whole area, there's an imbalance here. So when you spot your imbalance, you mark from tail to tail, not body to body. And then you mark 50% of the box that you have drawn or of the gap of the imbalance. And as soon as you reach your 50% of that gap, you start taking entries up to the 100%. And then your stop loss is here on the first candle that you see. So your stop loss will be somewhere here. I think I've explained it in a way that you can see. Sorry, I'm kind of now rushing. Why? Because of our time. Okay. Right. Let me go back to the questions. Let me see if I can answer 1 or 2 more questions. How do you determine the trend of the market? Can you kindly visit our YouTube channel? We talked about that, I think, last week when we had a Zoom session, whereby we said break of structural highs and structural lows gives us the overall direction of the market, also depending on the time frame that we are using. Any guidelines on choosing lot size depending with account size? Right. I'm going to send you a sheet that I made about lot sizes. I've been working on it. I'm done with it now. Account size and lot size, account size and lot size. So don't worry about that. How do you set up TP for trading imbalances? And are there any rules that can help to figure out which one is valid and which one isn't? Okay. The way that we set TPs now is, remember, we are trading either on retracements or either on pullbacks of a trend. And as it changes from that retracement to go in line with the overall direction. So remember, we said we set our TPs based on the next high that we are targeting or the next low that we are targeting. Hi, which brokers do you recommend for trading and how much would you suggest one start with? I trade with Deriv, with AvaTrade, and also with XM. Basically, those are the brokers that I trade with. So just depends. What about setting to targets when trading, TP targets when trading imbalances? I think I just answered this one. What's your YouTube channel? My YouTube channel name is Gold Forex. You can go on YouTube and you can search Gold Forex Institution, Gold Forex Institution. May I have DP2P to fund? Say, unfortunately, we are not having any giveaways for now. How long should I stay in a trade? Reward ratio. Usually, with this method of imbalances, you can target as big as 1:20, 1:15, or 1:20 plus is your reward ratio. Okay, don't go too much information. Okay, so we have less than a minute remaining, guys. Thank you very much for attending our Zoom session. Those who want to chat with me on WhatsApp, remember I gave you my number. For sorry for that. For repeating cases, this is my number. You can WhatsApp me there. We can talk there. Thank you very much for joining our Zoom session, guys. It's such an honor. Such an honor. Thank you very much. Have a good night and sleep tight. Hey, ndapava nawo information yakawanda in a short space of time. I gave too much information.